Okay, the unit 3 is about receivable management, or you can also call it as credit management. Okay, what are we going to do in receivable or credit management? We'll basically understand how you receive money from the people to whom you have sold goods and credit. Now, suppose you have sold goods to Mr. XYZ and he has promised to pay you after 2 months. So, after 2 months, how you are going to collect it? If he doesn't pay, what action will you take? If he pays in advance, are you going to give him some incentives? Who will decide that 2 months period that you should be paying only in 2 months or 3 months or 5 months? Deciding all this and working on all this is called as receivable management. So I'm managing my receivables, how I will receive my own money. So let's understand the theory, some part of it first, and then we'll go to the problems. The term receivable is defined as debt owed to the firm by customers arising from sale of goods or services in the ordinary course of business. So only when you sell goods or services and the customer has still not paid, we call it as receivables. Okay, so when a firm makes an ordinary sale of good or service and we don't receive the payment, we create an account called as creditors account or receivables account, which will be collected in the future. Receivable management is also called as trade credit management, and firms grant credit to facilitate sales. If you don't grant credit, people may not buy goods from you. Like for example, if you say cash, you have to pay cash and buy, so no credit. If you put a board as no credit outside your office, the customers who don't have money would go out to your competitor who is ready to give credit and purchase goods from him instead of from you. So what will happen is it will impact on your sales. You cannot run business only on cash basis, because there will be certain times where the customer will be facing some difficulties and he will be willing to pay but at a later date. So only if you give him credit, he will purchase it from you. Otherwise, he will move to your competitor. So to facilitate or to increase sales, we basically do credit sales. Now, cost associated with receivable management. This is a very important question. You need to understand all these costs. It can be asked for 3 marks or 7 marks also. First cost is collection cost. Collection cost is nothing but the administrative cost incurred in collecting receivables. Administrative cost, by administrative I mean you need to keep records, you need to maintain accounts, you need to pay accountant's salary because he has to tell you the balance of how we have collected, and you need to have a separate receivable management team which will help you in receiving. You have to pay their salaries. So all these maintenance things that you will spend on are called as administrative cost. The next is capital cost. Now when you sell goods on credit, your money stuck up with that person. Like for example, suppose I sell 5 lakh rupees worth goods to Mr. ABC. Now ABC has told me he will pay me 5 lakh after 3 months. So till 3 months my 5 lakh rupees are stuck with ABC. And if I want to invest more, I don't have money left because I have sold goods and I have not received my money still. So what I will do, I'll go and borrow from a bank and I will invest more, and I'll wait for ABC to pay. After that, I will repay my loan. So when I borrow, I basically take the capital cost into picture, because when I'm borrowing, I have to pay interest. So I am incurring cost on that. Okay, so it is the cost on the uses of additional capital to support credit sales, which alternatively could have been employed elsewhere. If Mr. ABC would have paid me on time, I would have used that 5 lakh somewhere else. But because he's paying me later, I don't have my own money. So I'm borrowing from outside and I'm paying. So that's the reason I have a capital cost. Are you understanding the logic?
Yes, ma'am.
Next is delinquency cost. Delinquency cost is nothing but failure of a customer to pay on the due date. It is not that he will not pay. It is not bad debt. It is not default. He has failed to pay on the due date, but he will pay later. Now, as I told you, ABC will pay me after 3 months. So suppose I've sold him goods now in the month of November, and he said he will pay me in February. Suppose he fails to pay me in February, I'll call it as delinquency cost. That doesn't mean he will never pay me. He has not told I'll never pay you. He has said I cannot pay on the due date. I will be paying little later. So when he will pay late, I will again not get my own money in the month of Feb also. So I'll have to face the delinquency cost. That is a person who's giving in delay. I have to face that cost. I'll have to arrange money for my uses from somewhere else till the person pays it. And the last is default cost, which we also call as bad debts, where the overdues will not be paid or we cannot recover it. So APC has become a defaulter and he says, I'm sorry, I don't have money, I cannot pay you anything. So that becomes bad debt. So these are the 4 costs that are associated with credit management. We need to manage these costs well. Otherwise, if these costs are too high, then we will suffer losses. If we spend too much on collection, then our profitability will come down. If you borrow too much and give lots of money, stuck lot of money in credit sales, your interest cost will be high. If delinquency cost happens, everybody fails to pay on the due date. Whatever you had planned on the due date, you cannot execute it. You will pay electricity bill later. You will pay wages late because you didn't get your money on time. So those are all the costs. And if the person becomes a bad debt and he defaults, he says, I won't pay, then you will lose the entire money. So all the 4 costs are having an impact on your profitability. So you need to manage them well so that your profitability is increasing. So let's go to the next. Now, as I had told you, you need to decide on the credit policy. For how many days I will give credit, when should I receive, if I don't receive, what action will I take, if I receive early, am I going to give some discount? So all these things you need to decide and you need to have a policy so that you can give that policy to your customer and say, see, this is the terms and conditions on the basis of which I am ready to sell you goods on credit. So the credit policy of a company can be regarded as a kind of trade-off between increased credit sales leading to increase in profit and cost of having large amount of cash locked up in the form of receivables and the loss due to the incidence of bad debt. So when you give more credit sales, your profit will increase because your sales are increasing. But on the other hand, if that person defaults to pay, he doesn't pay, then your losses will also increase. So you need to have a balance between the two. So your credit policy will help you to do that. The term credit policy encompasses the policy of a company in respect of credit standards adopted. So very first thing, and on which we will be doing sums today, is credit standard. So credit policy will help you to understand your credit standard. The next is the credit period. So the second type of sums that we will do in this chapter is on credit period. Then the third we will do is on the cash discount. And the fourth part of sums that we will do will be on the collection efforts. So these are the 4 important things that you need to mention on the credit policy, on which we will also do sums, and how these factors will impact on the profitability of the company we will understand through sums. So these are the 4 important terms in the credit policy about which you have to give the details. So I've written it here. Thus, the variables associated with credit policy are credit standard, credit period, cash discount, and collection efforts. On all 4, we will have sums. And in case of all 4, the sums are by 2 methods. One is the formula method and the other is the tabular method. So in all 4 methods, we will have formula as well as tabular. Okay, so credit standards, we'll understand the meaning of credit standard today, and then maybe we'll start with the sum of credit standard. In the next class, we can continue with the other part of it. So the term credit standard represents the basic criteria for the extension of the credit to customers. So what is the criteria for giving you credit? Now suppose you started a new business and somebody comes, just walks away into your shop and says, see, I want to buy 10 cotton saris and 10 cotton shirts from you, but I will pay you after 2 months. you will not blindly give that products to him, right? Because you don't know who is that person. He has just walked in and you don't know his name, his details, his addresses, his financial status, nothing is you're aware about. So you will say, sorry sir, I have no idea about you. You need to make cash payment and you can carry the goods. I will not be able to give you credit. So what you did here, you have set a standard for giving credit. I will not give credit to anybody and everybody, because first thing is I should know that person. Second thing is his financial strength should be strong. He should be capable of repaying me that money. Thirdly, he has to maybe get some guarantee or has to have some office or shop, which I should be knowing the address and all those things. So you set certain standards, certain criteria on the basis of which you have decided whether I should give credit to this person or not. Okay. Then the second type of standard may be somebody you know very well and you know that he's not that financially well off, but he can pay. But he cannot pay a huge amount. So he comes to your shop and he says, I want maybe 1000 cotton saris and 2000 cotton shirts. Now you know he doesn't has a capacity to pay for such big huge order. So you will tell him, okay, you make the payment and carry. If he says, no, I need credit, you will say, see, I cannot give you 100% credit. You pay 50% of the amount and remaining 50% you pay after 2 months. So what you did here, depending on his financial strength, you decided his credit. So the standard was the financial strength. So this customer, according to you, cannot pay 100% amount later. So you tell him, I'm ready to give you 50% credit. First customer, you said no credit because you didn't knew him at all. Second customer, you said 50% credit because you know him, but you know that his capacity of paying back is very low. Now the third customer comes and he is very rich, well off. He has made all the payments on time. You know him and you have been dealing with him for years together. And he takes a huge lot of goods and says, I want credit. You blindly tell him, okay sir, you can make the payment after 2 or 3 months because according to your standards, you know him very well. His financial strength is good. He has a guarantor. He has a known name in the market and you are sure that he will be able to pay. So you set certain standards on the basis of which you divide your customers. If the customer fits into all the standards, you give him 100% credit. If he doesn't, you give him partial credit, 30%, 50%, 60%. If he doesn't fit at all, you give him no credit. So this is what the credit standard is trying to say. Are you understanding what I mean?
Yes, ma'am.
So you can read the slide, it all mentions about that only. So we'll start with the credit standard sums, remaining I will be dealing it later. So the third unit, questions on credit standards. The first question. Now before we start solving with the question and answers, I will give you the formulas first. Formula for credit standard. So the formula starts with delta Ri. This is the sign of delta. I will mention it here as delta Ri because it's the sign is not working, but in the exam you can write that triangular sign of delta. Delta Ri is equals to, what is delta?
Change.
Correct, change. Change in residual income. Ri is the residual income. So delta Ri is nothing but change in the residual income, which is equal to delta sales, so the triangular sign, That means change in sales into bracket 1 minus V. V is nothing but the variable cost. Close the bracket minus delta S BN. S is the sales and BN is the bad debts. So you close the entire bracket. From this you will do 1 minus tax rate. And after getting 1 minus tax rate answer, you will do K into delta I. So you're multiplying K with delta I. Now what is delta I? The formula for delta I is delta S divided by 360 into ACP into V. What all these terms mean, I will write it here. Delta Ri is equals to change in residual income. Next, delta S is equals to change in sales. V is equals to variable cost. T is equal to tax rate. BN is equals to bad debt loss rate. So rate of bad debt loss. K is equals to post-tax cost of capital. Then delta I is equals to increase in investment. ACP is equals to average collection period. So these are the formulas that we will use. These two are the formulas, and this is what all those things which we have used in the formula means. Okay. Should we start with the first sum?
Sure, ma'am.
Yes, ma'am.
Okay. Let's see the question. Okay. The current sales of Pioneer Limited is rupees 100 million. Okay. The company, now it is the current sales 100 million. It's not change in sales, so we will not record it here as of now. The company classifies its customers in 4 categories. Pioneer currently gives credit to customers in category 1 and 2, unlimited. So if you come under category 1 or 2, you get unlimited credit. That means there will be no restriction. As much as goods you can take all on credit. Limited credit to customers in category 3. If you fall under category 3, I don't trust you much, then I'll give you limited credit. And no credit to customers in category 4, which is if I don't know you at all, you're a new customer and I don't want to take risk, I will not give you any credit. So he has decided 4 standards. If you fall under standard 1 and 2, you can take as much as credit as you want, buy any goods and pay later. If you fall under category 3, I will give you limited credit, and 4, I will give you no credit. So this is the existing policy of Pioneer Limited. And by using this existing policy, they are making a sales of 100 million. Okay, so 1 million is equals to 10 lakh rupees. So 100 million will be almost 1000 lakh rupees. Okay, or you can also say 10 crores. Okay, as a result of this, company is losing sales to the extent of 10 million in category 3 and rupees 100 million to customers in category 4. Because they are following this policy, what is happening is they are losing sales. Why they are losing sales? Because category 3 people say you are giving limited credit, so I cannot buy more goods from you. So he is buying less, therefore 10 million worth sales are lost. And category 4 says, when you will not give in credit, I cannot buy from you much. I don't have cash. So therefore, they're losing almost 100 million of sales in category 4. Now, what happens if we lose sales? Our profitability will come down, our targets will not be achieved, and the competitors will go ahead of us, which we don't want. It is obvious that we want everything to be done better than our competitors. So what happens? The company is planning to adopt a more liberal credit policy. What do we mean by liberal? By liberal, we mean the company is planning to relax the credit policy. So they want a more liberal or a more relaxed version of the credit policy. So what we'll do in the relaxed version? Such relaxation would increase sales by rupees 15 million. So what is happening with this? The sales are increasing by rupees 15 million. Now when the sales increase, we call it as delta S, change in sales. The value of sales is increasing, right? It has become 15 million. So I got my first factor, that is delta S, which is equal to 15 million. Now I told you 1 million is equal to 10 lakhs. So 15 million will be equal to 150 lakhs. Okay. So solution. I got the first value. If I change or relax my credits standards, my sales will increase by 15 million. That means the change in sales will be 150 lakhs. On which bad debt would be 10%. This is nothing but my BN, the bad debt proportion or the bad debt rate will be 10%. So when I give more credit, my loss of bad debts also will increase because I'm giving credit to category 4 and 3 customers whom I don't trust so much. When I don't trust them, my bad debts will also increase. The contribution margin ratio for the firm is 20%. Now, what is this contribution margin ratio? It is nothing but the gross profit. And how do we get the gross profit? By doing sales minus variable cost. So they are telling you that the profit is 20%. So how much should be the variable cost? 80%, right? It is basically like this. If your sales are 100%, from this I'm minusing the profit, the contribution margin 20% to get the variable cost of 80%. Are you getting the logic?
Yes, ma'am.
Instead of directly giving you the variable cost, they have given you the contribution. And it is also, if you have studied it in cost accounting, we basically do sales minus variable cost and we get contribution. So here they have given you the contribution, which is 20%. So we'll assume sales to be 100%. 100 minus 20 if I do, I'll get my variable cost, which is 80%. Okay. Now the average collection period is 40 days. So I want the ACP value, which is nothing but the average collection period, which is 40 days. And the cost of capital is 10%, which is nothing but the value of K after tax cost of capital, which is also given 10%. Assume a tax rate of 40%. So my T value is 40%. Calculate the impact of relaxing credit on residual income. So we have all these things. Now we have to find what will be the impact of this on the income. Why they are calling it residual income? Because after meeting all the costs, whatever income we get, we call it as the remainder or residue. That's why they call it as, instead of calling it as profit, the word used is residual income. So these are the formulas that we will be using to find the answers. We have to find delta Ri. That's what is asked here. Calculate the impact on the residual income. To calculate the impact, we need the change in residual income. Now, before going into this, we first need the value of delta I, which is nothing but change in investment. So, we'll first find the value of delta I. Delta I is equal to delta S. Tell me what is delta S?
1 crore 50 lakhs.
So, it's 150 lakhs. We have to do divided by 360. So, first you need to divide it. Okay. Then you need to multiply it. So, into average collection period. How much is average collection period given? 40. 40. So into 40 we will. And then again we have to multiply it with V. V is what? The variable percentage. How much it is? 80%.
80%.
We cannot take 80. It is 80%. We should convert it into decimals. So 80 divided by 100 if you do, you get 0.8. Is this clear? So can anybody do it? 150 lakhs divided by 360 you do first. Then whatever answer you get, you multiply it with 40. Then whatever you get, you multiply it with 0.8.
13,33,333.33.
Correct. So delta I value 13 lakh 33,333.33 is recurring. So we'll just take 2 digits after the decimals. Is anybody getting any other answer? I hope all of you are trying. First you need to divide it and then you need to multiply. Okay, so that was delta I value. Now let's go to delta Ri, which will be a final answer. So delta Ri is equals to into bracket delta sales, that is nothing but change in sales, which is 150 lakhs, into 1 minus variable cost. So 1 minus 0.8 is the variable cost. So first we will do 1 minus 0.8. Then you do minus SBN. Now just see here, they have told you to use SBN. Sorry, it's delta SBN. So we have to take delta S. I'll take it in the bracket again here. Delta S is 150 lakhs into BN. BN is nothing but the value of bad debts. So that is 10%. So I'll take into 10%, which is nothing but 0.1. Okay, so this is done. I'll close the main bracket also. Now what I have to do next, whatever answer I get, I have to do 1 minus the tax rate. How much is the tax rate given? 40%. So 40 divided by 100, the tax rate will be 0.4. Once I get this answer, I have to minus K. What is K? K is the cost. That is 10%, which will be again 0.1. K into what we have to do? We have to do K into delta I. So here is the formula K into delta I. So to do this, we have already found the delta I value in the previous step. 13,33,333. So 13,33,333.33. This is the delta I value. Now I have written down all the values in the equation. I'll tell you how to solve it. You solve and tell me the answer one by one. First, what you do is you do 150 lakhs. 1 minus 0.8 is how much? So 150 lakhs
0.2.
into 0.2 you do first.
30 lakhs.
How much?
30 lakh.
30 lakh. Minus, now you do 150 lakhs into 0.1.
15 lakhs.
1 minus tax rate, if I do, 1 minus 0.4 is 0.6. Okay, then minus, now you do 0.1 into 13 lakh 33,333.33.
1,33,333.33.
Okay, so next we'll solve. Now 30 lakh minus 15 lakh is
15 lakh.
15 lakhs.
into 0.6 you do.
9 lakh.
9 lakh.
9 lakh minus your 1 lakh 33,333.33.
7,66,666.67.
7 lakh 66,666.7.
6 7.
So this is your delta Ri value. Now your delta Ri value is positive. That means when you give more credit, your profit is increasing by 7,66,666. So that means it is good for the company to relax its credit standards and give more credit. But suppose if this was negative, if I would have got minus 7 lakh, then I would have said the relaxing of credit period or credit standard is leading to a negative impact on the profit. So we should not give credit. In our case, it is having a positive impact and it is increasing the profit by 7,66,666. So we need to basically see it like this and solve. Any doubts in this problem as to how we got the value?
No, ma'am.
Ma'am, only that K value I didn't understood.
K value is
10%.
given in the question. See here, 10%. Here, I'll show you. Here, cost of capital,
Okay, ma'am.
10%. So it is given, it will be given in the problem. Only thing we have to find the delta I, which will not be given, and using that delta I, we can solve by putting it in the main formula and getting it. What you have to remember is first what to multiply, then what to minus. That is very important. If you get confused there, then the answer will be wrong. So that's why I put it again in the brackets for you. First, you should do delta S into 1 minus variable cost. Whatever answer you get, from that you minus delta S into bad debt, and then 1 minus tax and K into delta I. So this is the way you will have to solve it in the exams also and understand it also. So I hope the first problem was clear with everybody.
Yes, ma'am.
Let's do the second problem, which is also on the basis of formula method. Apex Limited classifies its customers in 5 categories. So the question is shortened here. Everything is not given in detail. Category 1, how much this, that. So directly, it is considering relaxation of credit limit. This would lead to increase the sales by rupees 90 lakhs. So here, your delta S will be equal to 90 lakhs. Okay, next, on which bad debt loss would be 10%. So BN value is 10%, the bad debt loss. Contribution margin ratio is 20%. Again, see here, they have not given you the value of V, but they have given you the profit value. So how do you find V?
100 minus 20.
100 minus 20, which is 80% will be the contribution margin. So 100% minus 20%. 100% we are assuming it to be the sales and 20% is the contribution margin. Okay, so we got the variable cost percentage. The next, Average collection period is 50 days. So ACP, that is average collection period, is given as 50 days. Cost of capital is 12%. So the value of K is given here. 12% is the cost of capital. Then tax rate is 40%. P is equals to 40%. What would be the effect of relaxing the credit policy on the residual income? So again, we'll use the same formulas and find delta I first and then find the change in the residual income. So for delta I, we need the value of delta S. That is nothing but change in sales. So that is 90 lakhs, which is given here in the problem. So delta S is 90 lakhs divided by 360. First we divide and then we multiply it with the average collection period, which is given as 50 days. And then we multiply it with the variable cost percentage, which is 0.8. 80% divided by 100 is 0.8. So we are going to use that. So just see 90 lakh divided by 360, how much you get?
25,000.
25,000. Then you multiply it with 50 and then multiply it with 0.8.
Ma'am, 10 lakh answer.
So your residual, your change in investment, that is delta I, is 10 lakh rupees. Now that we have the delta I value, we can find the delta RI value, that is nothing but the change on the residual income. So delta RI is equal to, first is delta S, that is 90 lakh change in the sales, into 1 minus variable cost. So 1 minus 0.8, 80%. So 0.8 is the variable cost. Then you minus again delta S, which is 90 lakhs, into BN. BN is the bad debt proportion, which is given here as 10% bad debt proportion. So we take here 10%. 10% means 0.1, 10 divided by 100 if you do. Then you find, close this multiplication. Then you find 1 minus tax rate. Tax rate is 0.4 minus K. The value of K is given here. Tax rate and K, if you see, the value of K is 12%. So 12% means 0.12 into delta I, which you have calculated 10 lakh rupees. So we have to multiply 0.12 with 10 lakh rupees. So let's solve it further. Delta Ri is equal to, see 90 lakh, first 1.1 minus 0.8 is 0.2. So 90 lakh into 0.2.
18
18
lakhs. Minus 10 lakh 80,000.
Minus 90 lakh into 0.1.
9 lakh. 9 lakh, ma'am.
Then 1 minus tax rate, if you do, you get 0.6 minus 0.12 into 10 lakh. 1,20,000.
Yes, ma'am.
So now you multiply 18 lakh minus 9 lakh is 9 lakh into 0.6 you do
5 lakh 40,000.
5 lakh 40,000 minus 1 lakh 20,000, which is delta K into delta I. So how much you get delta Ri?
4 lakh
4 lakh
20,000.
20,000.
Is that clear?
Yes, ma'am.
So this is how you will have to do the sums with the formula. The only thing is the problems are easy, but the Formula should be remembered in exam. You will not get any formula sheet. You need to by heart it and go, or you need to understand the logic and go. So now I'll explain you the logic behind the formula so that at least the by hearting part is reduced. Is there any doubts in that sum, the second one which we did?
No, ma'am.
Let's understand how the formula has to be remembered. So what's the logic behind the formula? Okay, I'll just show you in the Excel sheet by putting it in a tabular way. Okay. So if you remember profit and loss account or income statement, first what we used to take always start it with sales. Yes or no?
Yes, ma'am.
Remember, right, when we were doing income statement in accounting, last sums I taught you income statements, where we first take sales, then from that we less variable cost, after you less variable cost, you less bad debt loss, what you will get is profit before tax. From profit before tax, you less tax, you will get profit after tax. Now see the formula and we'll correlate with this. See first what we are taking, delta S means sales, change in sales. So I'm taking here sales. Okay, from that what we are doing, 1 minus V. 1 minus V means we are minusing the variable cost. Percentage it is given, so we are doing 1 minus V. So see here next, less variable cost. After minusing the variable cost, we are seeing if there is any other cost. In this case, any other cost is nothing but the bad debt cost. So we are minusing the bad debts. So less bad debts. After we do that, we get a profit figure. So we call it as profit before tax. From this, we are minusing tax. See here, 1 minus tax is removed. When you multiply it with 1 minus tax, that means you are removing tax, and if 40% is the tax, you're removing 0.4 and only 60% of it you're taking. So after you minus tax, you'll get profit after tax. So till here, whatever you got is your profit after tax value. From this, at the end, we minus the cost of additional investment. So if you're borrowing, what is the loan amount or cost that you will be paying as interest? Cost of additional, or you can also call it as incremental investment, because we are taking delta I, so that means it is additional or incremental. So you need to less that, and what you will get is profit, or you can also call it as residual income. This is the logic of the formula. If you cannot by heart it, understand it. From sales, we have to minus the cost. So first we'll minus the variable cost. So delta S into 1 minus V. Then we'll minus the bad debt cost. So minus delta S into BN. We will get profit before tax. From that we will do 1 minus T, which is minusing the tax. We'll get profit after tax. And after that, the only cost remaining is K into delta I, which is nothing but cost of additional investment or incremental investment, which we will minus to get the value of residual income. So that's how the formula is made. If you cannot by heart it, remember the logic and redo or rework on it. So this was about credit standards using formula method. Anybody having any doubts? Is that clear?
Yes, ma'am.
Okay. Now the third sum is tabular method. So you want me to start it now or we'll do it in the tomorrow's class? This is not formula. We have to use a table or a tabular method to solve it. Okay. Now how do you understand for which sum you should use table and for which sum you should use formula? So first thing is you have to search for the word residual income. This is the third sum. Just see in the third sum at the end what they have told you. Should the firm relax the credit standard? It is also assumed that increased sales will result in additional working capital of 10,000. So here at the end you will not find the word residual income anywhere. In this case you should use the tabular method. And here if you go, what is the impact or what would be the impact of relaxing it on the residual income? Look at the second sum, there is a word residual income. Look in the first sum, calculate the impact on the residual income. So only when there is word residual income or impact on residual income, you will be using the formula. If that is not there, we'll do it using the table method. By tabular method, I mean we'll use this method. So we will write sales, less variable, less bad debts, and whatever cost that we have. So instead of putting it in formula and calculating, we'll put all the values in the table and we will calculate. Okay, is there any other doubts?
No, ma'am.